Today, we're going to venture into yet another area in which Moore's law, or technological change, is in direct conflict with our tax laws, which, after all, were largely designed in the 19th and 20th century when people didn't travel much and commerce was largely local. And our focus today is on telework, or how we can create a telework-friendly tax code at the state level. And this is an issue that's been percolating for some time, but was really brought to a head by the coronavirus pandemic. Millions of people are working teleworking today, including here at the Tax Foundation. And guess what? This is what enables us to have these kind of events in a sort of a telework format. So we have companies, investment firms, consulting firms are all finding that they can operate just fine remotely. But these new ways of working are colliding with things like convenience rules, Nexus rules, and non-resident income tax laws, geeky terms like that, which we'll explain during this program. And we'll dig into those issues in more detail with our panel in a minute, but I'd like to introduce our kickoff speaker, Congressman Chris Pappas, who represents New Hampshire's 1st Congressional District. Being a native of New Hampshire with its friendly tax climate, he has a keen interest in this issue, but he's also a co-sponsor of the Multi-State Worker Tax Fairness Act, designed to avoid the double taxation of remote workers. So Congressman, I know you have only a few minutes before you have to get back down to the floor. So thank you for your time. Just kick us off today and tell us about your bill and how it would prevent double taxation for commuters who live and work in a state other than the one in which their office is located.
Sure. Well, Scott, thanks for the opportunity to join you, and I appreciate being on here with this panel. This is an issue that our office has been hearing a great deal about, and it's not a coincidence because New Hampshire has a very special tax climate. We guard it fiercely, and we also have a lot of our residents who are working in the Boston area over the border in Massachusetts. Our economy, just for so you all know, is really tied to the Metro Boston economy. One of the recent studies that I read showed that New Hampshire has one of the highest percentages of residents who were born someplace else. In one of our border counties, Rockingham County, right next to Massachusetts, 3 out of 4 residents were born outside of New Hampshire. Many people chose New Hampshire to come here from Massachusetts for the low tax environment, for good local schools, for the natural environment. It's a really great place to raise a family. And while we certainly struggle with affordability issues like every other state, we're certainly more affordable than Massachusetts. And so our proximity to Metro Boston means that we have one of the highest proportions of residents who work out of the state as well. A recent estimate said that 123,000 Granite Staters work out of the state, including 100,000 who commute to Massachusetts. So that's 100,000 workers out of a statewide population of roughly 1.3 million, which gives you a sense of the scope of what we're talking about here and how many folks are affected by this tax change in Massachusetts. So our office started receiving calls a few months back from constituents who were surprised to learn that the long arm of the Massachusetts tax collector was reaching into their wallet for remote work that was physically performed in New Hampshire, a state with no income tax. These are workers who are staying home, mind you, to stop the spread of COVID because of the ongoing public health concerns. So they're doing their part to stay socially distanced, to continue to do their jobs in a remote setting. And we know that, for many companies, remote work is going to continue, not just through the winter, but into the spring. And so I think this decision by Massachusetts to temporarily impose a sourcing rule on New Hampshire residents is really unfair. I don't think it helps our overall efforts to keep people safe and is not going to ensure that households are financially strong. So, we're certainly not going to go down without a fight on this particular issue. And one of the things that we've been looking at is what can we do at the federal level to try to simplify things, to try to make sure there's no double taxation in states, and to try to make sure that, my own constituents aren't liable for telework performed at home for out-of-state companies. So I was really glad that Congressman Himes had a bill that he had introduced in past sessions, and we helped him introduce it in this one. It's called the Multi-State Workers Tax Fairness Act, and it looks to address these complex multi-state tax codes to ensure that employees will only be subject to the tax laws of their state when they telework. And I know the Senate has taken an interest in the issue of double taxation as well. They had a provision in the HEALS Act that was proposed at one point which would put a moratorium on double taxation, which I think is sensible and worth taking up. So I hope we can continue to build a bipartisan conversation around this. Really, this comes down to an issue of fundamental fairness. I personally believe that my constituents shouldn't be liable to taxes from Massachusetts, even as this is a change. We should all be honest about that. Massachusetts, for a long period of time, gave credits to folks that were teleworking from home in places like New Hampshire, and now they have changed that policy. So I think this change is really unfair. And we've got to be honest, the pandemic's not going away overnight. The way we work is going to continue to change even well beyond COVID. So while telework is going to be temporary for some in the coming months, I think it's going to continue to increasingly be a new way of doing business for many. So all the more reason why we need to make sure our tax codes are fair, that they're reasonable, and that they truly account for where the work is performed. So that's what our bill is aiming at, and really appreciate the opportunity to come on here and discuss that a little bit with you.
Well, thank you very, very much. I appreciate your efforts on this. And one last question before you go, are you finding more support among your colleagues? Because you can't be the only member to have constituents in this kind of a problem.
Well, it's interesting. I've come across a number of folks who represent districts that have a big commuter population. And when you think of states like Connecticut, New Jersey,
Sure.
Lots of states along the eastern seaboard, this is an issue. And I know I've been learning a lot about this. Every state has a different tax code. Some have reciprocity agreements and things that add additional layers to this conversation. So it is complicated, but I think we're trying to get at the issue of fundamental fairness, and everyone I talk to seems interested in it and willing to listen to it. And that's why I hope in all corners of the Capitol, we can continue to push this conversation forward. It's really an onerous burden, and we shouldn't be disincentivizing telework when it's really so important for us to save lives and keep people safe. So we'll see. And hopefully as we have the conversation about COVID relief, we can look for ways to provide support to state and local budgets that are experiencing revenue shortfalls. I think that's one way that we can prevent states from trying to get creative and really trying to make up for revenue loss in a way that's punitive. And so the federal government, I believe, has a role to play there.
Well, terrific. Well, thanks again for spending some time with us. Good luck with this effort. We will track it very, very closely as we always do. And I wish you could stay for the rest of the panel, but I know you got to get back down to the floor for your bill. And thanks again, and we'll keep in touch with your office as this process moves forward.
All right, Scott. Well, be well. Thanks for all your advocacy.
Thanks again. Well, as I mentioned at the beginning of the program, our discussion today will focus on 3 impediments to a telework-friendly tax code. Such things as convenience rules, which we find in 7 states, and which the congressman was just talking about, which impose an income tax obligation if a worker's office is in the state, whether or not they've set foot there. Nexus rules, which can expose businesses to corporate income and other business taxes in states in which they did not previously have taxable nexus, simply because an employee is now working from that state. And non-resident income tax laws, which can impose filing obligations on workers starting the very first day that they work in a state. And so we're going to dig into all of these issues, discuss some of the potential state and federal solutions as we started with the congressman's remarks, and also talk more broadly about this patchwork of state laws will complicate many businesses and corporations' long-term transitions to remote work in this new environment. So I'm going to turn the program over to 2 people who know more about these issues than virtually anyone, Nikki Dobe and Jared Walczak. Nikki is Senior Tax Counsel at the Council on State Taxation, COST, where she works on state and local income tax matters and multi-state tax issues. And Jared is Vice President of State Projects at the Tax Foundation. Welcome to both of you. Now, this is the kind of program I really love because I get to sit back, listen, and have my tax IQ raised just by listening to 2 very, very smart people. So I'm going to toss out a few questions, broad topics, and I'm going to step back and let you 2 educate us on these issues. So maybe you could start by walking us through some of the consequences of the three issues that I outlined in the introduction, and then just turn your attention to the fixes. It's clear that remote work isn't going away, even after the pandemic is over. Look, so many businesses these days are finding it just as convenient to work remotely as in the office. And so, what would it look like to have a telework friendly tax code? So, Jared, let me kick it over to you and let you and Nikki raise our tax IQ.
Well, thanks, Scott. And these are, I think, really interesting and, as you say, very timely issues. Many of these issues are not new per se. The remote work question has, sort of dogged Congress and the states for a long time, but it's becoming way more relevant now because so many people not only are perhaps working remotely because of the pandemic, but will probably do so at a much greater rate after the pandemic. We're going to see far more people who find remote work convenient and more workplaces that are willing to do that. And the tax codes of many states can greatly complicate that. It can make it really hard for companies to give that okay. What they may be doing during a pandemic is not necessarily what they can do in normal times if tax codes don't change. And there can be some rude awakenings even right now for employees who aren't aware of what their tax burdens and obligations are going to be. And when they go to a tax preparer next spring, they may have some real surprises, which isn't the way you want to have tax policy running. So we want to walk through, I think, again, these three issues, sort of what would make sense, firstly, how does this all work in really broad overview? I mean, maybe do that, and then Nikki and I can go into some of the details of the ways it's not working. Because, a lot of people work in multiple states over the course of a year or live in one state and work in another. And typically, if you do that and you're actually physically going to an office somewhere, there's a system that more or less works. So let's say you live in state A, but you work in state B. State A, your home state, your domiciliary state, has the right to tax you on all of your income from all sources. That's your wage and income, your salary or whatever. It's also your investment income, any other sources of income you may have. A state in which you work, the state B, they can only tax you on the income you earn there. Lots of different ways that's calculated, but you have to earn the income there for them to tax you. This immediately sounds like double taxation, but the good news is that your home state will offer you a credit for the taxes you pay to that other jurisdiction. So you file in both places, but then your home state allows you to take a credit against the taxes you paid elsewhere for work that you performed in a state other than your home state. That's how it normally works. Some people even have a better arrangement. Actually I do, because I live in Virginia, I work in DC. And DC, Maryland, and Virginia have a reciprocity agreement where they just all agree that you only pay taxes to one state. You only have obligations in one place. You don't have to worry about credits. You don't have to worry about double filing. It's taken care of. Some people are lucky enough to live in those jurisdictions. But either way, ideally, you're not being double taxed. But there are a few problems that can quickly arise. One is, as we'll get into in just a moment, these so-called convenience rules, which can override this because if you think about it, you've got a state that's taxing you based on where you work, but it's not necessarily where you're actually working. You, from the perspective of your home state, are in your home state. You're both living and working in your home state. You're probably not eligible for credit for taxes paid to another state. So now you've got taxes that are owed where your office is. You also have taxes owed in your home state, and there's not necessarily an offsetting credit. That becomes a huge issue, and that's one of the things we're going to discuss. Another situation, obviously, is that while it's a little less so right now, a lot of people are really mobile over the course of a year. They work in a lot of different places. Maybe they travel for work. Maybe they travel for other reasons, but do a little work. And you have 24 states that theoretically give you a filing obligation the very first day you do any work in that state. In practice, I suspect that most states aren't paying a lot of attention to this for the person who shows up for a day or two. You probably owe $0 in tax, even if you have a filing obligation. And, as much as that's the law, I don't think states are looking to get the $0 returns at a high level. But nonetheless, people maybe during a pandemic who stayed with relatives for a week or two. This creates an issue. If you've relocated for a longer period of time, if you've been somewhere 6 months, I think everyone understands and expects, you owe taxes where you've been living, where you've been working, and you got to deal with the credits issue. But there are a lot of ways you can be exposed to taxes you didn't expect. And then finally, as people disperse across the country, they're exposing businesses to taxes that they may not have previously paid. And we'll get into what that means because it gets a little complex. But the basic idea is that just because a company sells its products into a state doesn't necessarily mean that it has a corporate income tax or other business tax obligation in that state. But there is something that could be taxed if they had Nexus to allow the state to tax them. And having an employee show up there can change all of that. And that's a really big deal. It can expose companies to an awful lot of taxation. Right now, businesses are really just going with it, and we'll see what happens with that. But they're not usually restraining where people can locate. But normally, that's a decision that businesses make very consciously. It's going to interfere with the ways that we can allow remote work in the future if some of these things don't get addressed. So, Nikki, maybe if you want to talk a little about maybe start with the convenience rule, go into a little more detail if you wouldn't mind on what exactly is going on here, and we can have a discussion about these 7 states that have one. I think there's a threat that it could be more than 7 states in the near future, and what this really means for individuals and their employers.
Yeah, thanks, Jared. And, this is a really important issue, this idea of the convenience rule. And I think there's also a lot of confusion about what it means.
Yes.
And frankly, in the Western states, a lot of states have more of a very straightforward, if you are a non-resident, you are only subject to income for work you perform in the state. I think that is a much clearer rule. We know where we're performing work, and in these times, where we're performing work in a different state, we have a clear idea of what that means. The convenience rules, however, say that type of thing applies only if it is for the convenience of the employer. And so a big question arose as we came into this pandemic of what does that mean? If your employees can no longer go to their office because they are trying to stop the spread of COVID, are they doing that for the convenience of their employer? So have they now triggered a tax obligation because they're no longer doing this merely for convenience? And it is essentially as they're doing it because they're required to do so. Their offices are closed. They are under restrictions from their own states for traveling. They're under restrictions from the other states to not travel into that state. So I think there's been a lot of confusion about these rules during this time. Your sense, I think you guys do deal with them a lot more on the East Coast. Did they work pre-pandemic? Do you think that was a good rule pre-pandemic? Because that's been a little confusing to me as I've heard this issue debated is, were these a good idea before? I think now we kind of clearly know they don't really work in this current situation. But what if we're back to a normal situation? Do you think they should stick around in that circumstance?
They really don't make sense from the basic principles of taxation that, you ask the question, who should be able to tax an activity? There needs to be some sort of meaningful economic relation between the individual who's being taxed and the entity taxing them. Clearly, if you're physically working somewhere, that relationship exists. You are benefiting economically from a state and its economy. If simply your business has an office located there, and that's theoretically the one you're associated with, even though you're working somewhere else, that's a really, really tenuous tie. You're not really benefiting from that state in any meaningful way that would be subject to taxation. Your company is subject to business taxes in that state, but you as an individual really aren't. And it doesn't make a lot of sense for that state to have this prior claim on your income. And note that even in a scenario where you got the credit from your home state, this would be denying taxes to the place where you're living and working and actually benefiting from state government and giving it instead to a state where you may never set foot. In reality, of course, you'd end up paying in 2 states, which I think almost everyone would agree is unfair. It doesn't make sense that you would be double taxed. It becomes a much, much bigger issue now. This convenience rule, let's unpack that a little more. It's that question, as Nikki said, is something being done for the convenience of the employer. And that is the test, but convenience is not really well defined. So things that would not trigger this rule, let's say that you are a traveling salesperson for a company and you are exclusively associated with the Midwest, like that, your job requires you to be there. Like you're doing the work, not just out of some broad convenience, you're doing it because it's core to the work. But other things, if they could be performed in the home office and there's not another office you're associated with, this is subject to taxation. And there is this really weird question. Well, working from home, that in a pandemic, that's really not a convenience. I mean, like, this is not something you optionally chose to do. It was mandated in most cases. But thus far, we've not seen any flexibility offered by the states that have convenience rules. They've indicated, well, theoretically, the work could be performed in our state. You know, New York's perspective, yes, you cannot go into your office. Theoretically, you could have chosen to live in New York. That's really not what, in my mind, convenience means. If you lived in New Jersey or somewhere else, that's not convenience to say you could have located your home in our state. It's a weak claim, but that's where it stands right now. Now, New Jersey's done something really interesting, something very pro-taxpayer, and they've said that they want to avoid double taxation. So New York making this claim, they're going to allow their own taxpayers to be held harmless by continuing to offer the credit for taxes paid to another state, even if you don't actually earn it. So New Jersey is waiving its right to tax a New Jersey resident who is working in the state, so that when New York taxes them, they don't get double taxed. Good for New Jersey, kind of unfair to New Jersey's treasury. Really unfair, I think, that New York is getting that revenue when New Jersey shouldn't. And if you live in a state that's not as generous to you as New Jersey is here, you're getting double taxed. And this is going to become, I think, a much bigger issue as we see a wider range of telecommuting and remote work opportunities. What company is going to want to be located long-term in a state that has a convenience rule if a significant portion of their workforce is going to be working remotely? And that's one of the perks of the job. How do you tell your employees, hey, we've got this wonderful perk, you can work anywhere you want. Oh, by the way, you're paying two different sets of income taxes. Obviously, some states are going to see this as a short-term fix, that if they've got this exodus during and after COVID-19 crisis, that, how do we claw back some of that revenue? But in the long term, I think companies that really care about creating a telework-friendly environment for their own employees are going to look for solutions. And sometimes that may mean assigning people to regional offices out of state. There are solutions short of moving your headquarters. If you're a smaller company that only has one location, I think you do potentially move it. It's clearly an issue that will dramatically interfere with people's ability to work remotely, and does, in my mind, send taxes to the entirely wrong place. There's also a legal aspect. Yeah.
Just to go back to something kind of your description of the convenience rule and all the different factors at play, I think we can't lose sight of practically how challenging it is to apply this, and how our business is supposed to apply this, and at what level of comfort can businesses get to make these decisions, because these are facts and circumstances determinations. And when you are sitting there as an employee or as an employer trying to make these decisions, how much time do you have to get into all the facts and circumstances of every one of your employees and what they're doing? Businesses don't have the time for that. But these are becoming major issues for both employees and employers. And so I think that we just don't want to lose sight of that fact, that these rules are out there, they seem real complicated, but they mean a lot to people, and they're also really complicated. And how much time are states going to take to go after people under these rules, and how much money can people spend to defend themselves or their businesses against these rules? I mean, there's also this equities balancing that has to be done. Is, at what point do businesses just throw up their hands and say, we can't do it?
Yeah, Nikki, I think you make a really important point there. When we talk about basic principles of taxation, simplicity is one of them. Predictability is really important. And we want tax codes to be simple for compliance in a lot of ways. We don't want people spending more money on compliance than they need to be, businesses or individuals. But when there's substantial uncertainty on what the correct outcome is, this is unfair to everyone. Decisions are made in advance that have tax implications that may be unexpected. Decisions might be foregone. You might not allow someone to do something because you don't know what the outcome will be. The compliance costs and the administrative costs are very high. And then, of course, you also get some things that can be enforced in the breach. And that will be true of, I think, all of the topics we're talking about here, where states' capacity to enforce some of these rules is limited. And it's sort of tacitly recognized that some of them don't even make sense for a lot of taxpayers. They're really about maybe a small class of taxpayers. And that's bad tax policy, to say we want a provision in place that we can go after a few big companies, a few high net worth individuals, and we technically bring everyone else into that net and create obligations that we sort of know will not be well followed. It makes scofflaws out of a lot of people who want to be honest taxpayers. It creates a lot of uncertainty. These are all really bad things. And in New York, which has had the convenience rule for the longest, they were the innovators on this, as they have been on a number of multi-state tax issues. We've seen litigation in the past trying to argue that New York does not have the legal authority to tax the economic activity, that the income that's not really generated in New York. And thus far, those claims have not really gone anywhere. New York courts have rejected them. Notably, they've only gone to New York courts. One of the really interesting things about this current dispute between New Hampshire and Massachusetts, which the congressman was alluding to, Massachusetts has been the most recent state to adopt a sourcing rule like this during the pandemic, is that New Hampshire as a state is upset about it and is looking to do something about it. We've seen responses and retaliation in the past. Connecticut actually adopted a sourcing rule that really is just reciprocal. It is targeting New York as long as New York targets it. But New Hampshire is potentially looking at a legal challenge. We're not there yet. They are, encouraging Massachusetts to take a step back. But that's really interesting because when someone who has taxes in New York sues over this, it goes to New York court. If a state intervenes, not only is there original, but there's exclusive, not just federal jurisdiction, but Supreme Court jurisdiction. Now, do they take that case? I don't know, but this is a really important issue that deserves probably a federal consideration. And you could imagine the federal courts having a different view on multi-state tax issues than New York courts have. So there's legal questions that can be resolved. There's also, obviously the congressional approach. Congress has significant latitude on multi-state tax issues. This falls under the Dormant Commerce Clause and the authority of Congress to regulate some of these things. Usually they don't. And I've already seen, we'll get to some Q&A later, but I'm already seeing multiple questions that are basically alluding to hey, isn't it really tough to do this? And especially haven't we seen members of the New York delegation, who obviously have a significant amount of sway in Congress, very opposed to this. That's very much been the case in the past with mobile workforce bills. It's bills on telework issues. All of these issues, I think the New York delegation has been dead set against because New York has been probably the greatest beneficiary of the current policies. Nikki, do you think that the pandemic and maybe the aftermath, where telework is way more important as a part of our economy, can break a logjam, or where do you see this going?
I would like to say I hope so. But this is an issue that Cost has been working on for a number of years. And pre-COVID, I kind of break this issue down into pre-COVID and pandemic. And pre-COVID, this was such an important issue because of all the traveling so many workers were doing, you and I included, Jared. I mean, we were on a plane almost every week going to states. As you mentioned, there are these 24 states where we were creating our own filing obligations just after a day. And many of us kind of had our heads in the sand because, it's just too much to comply with. Now, as we shift into the pandemic, everybody has hunkered down. But we've created a whole different set of issues. And these are the issues where now folks are potentially working in states where they weren't working before, and they may never go back to those states. And so that has kind of shifted the conversation. And I think it's also put the burden on many businesses and employees people feel, I don't want to say they didn't feel sorry for us and our travel schedule, but they're more sympathetic to. I don't think there was a lot of sympathy for employees and companies that had a lot of money to send their employees all over the country to do, maybe what some people thought was fun stuff. But now that people are having very real tax implications for having to work out of their home, where they maybe have, kids running around that they're trying to school and 100 of other things they're trying to do, I think there's much greater sympathy. And this issue, which was kind of seen as maybe a big company issue that Congress didn't need to deal with, is kind of getting a bit more, there's more kind of an outcry from the little guys or the small businesses, where I think we're seeing a lot more small businesses that are subject to these issues. So is it enough to break the logjam? That's a really tough question, and I think that we are in a really tough political situation generally. I will just leave it at that. And so I don't know that it's enough to break the logjam, but I think it has elevated these issues in a way that perhaps it hasn't allowed them to get the time and the attention that perhaps they've gotten over the last several years. So I think that hopefully with more conversations, we can maybe get there, but I think it will still be a challenge for sure. And one thing I would like to note on your comment about, original jurisdiction before the Supreme Court, we recently, this past year, saw one state try to sue another. Arizona tried to sue California. That was on a business issue, so the court ultimately decided not to take that case. But again, dealing with personal income taxes and residents of one state versus a resident of another and individuals, I think that, again, may garner more sympathy by the court. And so they may be more willing to address that type of issue when it is taxes coming out of individuals' pockets, as opposed to a state going after a business for taxes that, in some way, shape, or form, they can pass along to their customers. So I think that is maybe an important area to watch as well, and could also put some additional pressure on Congress to act. Do they want the first say on this, or do they want to let the Supreme Court take the reins? Now, if history is any indicator, we've seen that they've been more than willing to let the Supreme Court take the reins on state and local tax issues. So, that one could cut against us as well.
And I think that's right. Although, as you say something like a Wayfair decision on sales taxes, Congress being unwilling to say, hey, here's some new tax obligation is different than Congress stepping in and saying, oh, wow, some people have to pay two completely different sets of income taxes on the same income. I mean, I will just say anecdotally, I work on a lot of tax issues. There's a lot of things that I think are rather unfair, but there are very few issues that get the same visceral reaction when I explain this to someone. They say, wait a minute, I could pay two completely different sets of income taxes on the exact same income with no offset, just two states claiming that. That surprises people. And it's tough to get traction on this, but I think it's very important.
Well, it's also, anecdotally, I've had this situation in the past 3 years because I live in Oregon and I teach down in California. So I'm in this situation where California is taxing my income that I earn there. Oregon taxes all of my income. Oregon and California have a very odd reciprocity agreement. In order to get a credit, I have to file a California return. I don't pay any tax to California. I get the credit there. But I will just say I've had to file over 100 pages paper filing with California just to get this credit in California and avoid this issue of double taxation. And then I didn't check a box. I should know better, but I failed to check the proper box. And I had to spend probably 10 to 15 hours dealing with the Franchise Tax Board. So this is a very real issue that is very challenging, even for, as Scott's wonderful introduction, we're very smart people dealing in this. This is challenging for you and I.
For those who don't know Nikki, I will just say, if Nikki was confused about what you're supposed to do on one of these tax issues, a lot of people are going to be confused on this. And as I'm looking, we have other issues we want to talk about, but as I'm looking at the questions, there's one that I think provides a bit of a segue into one of the other two issues. But someone asked, well, wait a minute, with these convenience rules, you're saying if you don't even set foot in the state, you could be subject to it. The question was I thought that you had to be there for part of the year. I think that's an important transition into another related concept in multi-state taxation, and that's non-resident income taxes. Obviously, as we indicated at the start of the webinar, you can be taxed in a state where you work or earn income, even if you're not a resident of that state or part or full time. Usually often there are some thresholds that you have to meet to be subject to taxation, both on the filing side, the obligation to file, and the potentially having an obligation to remit taxes. So in many states, you don't get a resident standard deduction, but there may be some minimum amount you need to earn or need to owe before you actually have to pay a check. You're probably not going to write a $1 check to a state. There's a threshold before you have to pay. 24 states, however, say that you legally have to file if you've worked there for 1 day. It might be a $0 filing, but you have to file. Other states have different thresholds. It can be 14 days, it can be 30 days. I think there's a 46-day. There's this patchwork of different days. And this becomes really important in this broader conversation because people are moving around. They're working from different places right now, and they could be really surprised, I think, come next year when they have to file taxes. And hopefully people realize that if they relocated for 6-8 months during a pandemic, but that obviously triggers some tax liability. And I think most people would say that's probably fair, that if you've worked that long in a state, it seems pretty clear that their income taxes should apply to you. The question is, like, if in April you worked for 5 days from another location with family, should you have to file a tax form for that? Or, Nikki, you mentioned, like, you and I travel a lot. We go to a state to speak at a conference for 1 day. We're almost certainly not going to owe a single dollar of taxes to that state. Neither of us have the incomes to justify actually reaching those thresholds, but theoretically we might have to file. And that's something that I think often gets enforced in the breach, often gets complied with in the breach, but it's there. So there have been proposals over the years to try to address this. This is what's called the mobile workforce legislation, usually a couple of different names that have been given to it, but the idea that Congress could set a standard minimum threshold. You need to be working in a state for 14 days, for 30 days, something like that before the taxes can apply to you as an individual. Obviously states can also address this. They can raise their thresholds. 1 day is not really good for anyone. States don't want to file and to process a lot of $0 returns. That's not in their best interest. And some of them have kept this because they want the ability to go after maybe a really high net worth individual. There used to be the stories, maybe there still are, but there used to be the stories about New York, like more or less stalking out, business conferences and even airports looking for CEOs coming into the state for a day or two. I think that's not as common now, but that's one way that taxes were done, and probably not a great way to do this. To the question, there's the question of residency, because being domiciled in a state means that you can be subject to taxes on all your income there unless there's a credit somewhere else. And you do have to be physically present for some period of time in a state to be domiciled there. For people who don't have two homes, this is usually a really, really simple question: where do you live? For people on the wealthier side who have two homes, the rules get complex. It could be 6 months and a day. It can be where your business is located. There's lots of factors. I've even seen one where the guy's dog lived actually helped the courts determine which one was his actual home. It gets a little crazy. But to be subject to domiciliary taxes from a home state, you need to have some semblance of living there. But you pay taxes to a lot of different states potentially. Nikki, what are your thoughts on how this has worked thus far and what solutions might be? I mean, do you see states going after this, and what are your concerns?
Yeah, I mean, you're right on all scores, Jared. The states don't have the bandwidth to take this issue on head on. But and it's no surprise for you and I, we live in the state tax world where we know that every state can and may have its own individualized rule. It's very frustrating for other people that just say, well, if I go to another state, how long do I have to be there? Well, it depends. I don't think these rules work. I think it was Harley Duncan several years ago who said complying with the current system indeed difficult and practically impossible. I mean, from my perspective, and I've worked at a couple big four accounting firms, law firms. The big four do about the best job. But when I billed my time, I had to say where I was sitting. I also had to file 5 tax returns 1 year based on the fact that I had traveled to some of these one-day states and I had worked there. I didn't owe any tax, as you say, but I filed those returns. So it's very challenging to comply with. And that is just on the individual side. I mean, if you and I had to file tax returns for every one-day state we went to for more than 1 day, I mean, you and I would probably file, 12 to 15 different returns every year. And that would be very onerous. It would be very expensive. That would not be a filing I would want to prepare myself. And so it is very challenging. I think it also gets much more challenging for the employers because, as you and I know, we may have a filing obligation, but these rules also get transferred on to the employers to withhold that tax on our behalf. So for these states that have this one-day rule, technically, our employers should be withholding that income for that one day we were there. If those rules were actually complied with, if they could be complied with, then I think many states would get a huge windfall because because in order to get that tax back, if we actually didn't owe it, and in theory we shouldn't because we would be getting a credit from our home state, we would have to file that return to get that refund of any tax paid that we, because we wouldn't necessarily owe any tax, but we'd have that filing, it would have been withheld. And so in order to get it back, we would have to file to get it back. I mean, Jared, if you had a $5 withholding from, the state of Montana, which I know you've been to, would you, spend the time or the compliance costs to get that $5 back?
I guarantee you I wouldn't.
That's right. So I think it leads to all sorts of distortion that really shouldn't exist because, again, we have the tax obligation wagging the dog or the business decisions. And so I think this patchwork, it hasn't worked. I don't think it will work going forward. And I really think it would be wonderful to have a uniform solution to fix the problem. Now, again, uniformity, we know that's hard to come by in the state and local tax world. So what are our options? We've got this congressional option, and that has been in play for many, many years. Will we get there? Big question mark. Then the question becomes, can we get there on a state level? And I think that is where the conversation has shifted over the last few years pre-pandemic. We've had a bit of a pause there because we're trying to see if we can, what's the saying? We can make some lemonade out of these lemons that we've been given, but a state solution is our other option. So I'm not sure if you're quite ready to go there with the conversation, but I'll let you jump in.
Yeah, state solutions are often very challenging on this. State cooperation is difficult in any tax issues, and we've seen that certainly. In fact, if anything, we've usually seen states pushing in the other direction when there's any concerted effort trying to increase their ability to impose taxes. And this happens on the business front, because we have all these people right now who are maybe working remotely, working in a state where they never worked before. Their business doesn't have an office there. And this can create new obligations, not only for them, not only for their employer in terms of withholding, but also obligations in terms of business taxes. And the way this works, and Nikki, you might want to go into more detail, but there is this law in the books, PL 86-272, a federal law, that it was meant to be a stopgap. It was supposed to be like a one-year solution to a problem that arose because of the Supreme Court decision. You're going to be shocked, everyone on this call, to learn that like 60 years later, they never did anything about the stopgap and never solved the real problem. But the idea was that a company could not be exposed to the tax code of another state just because they sold tangible property, goods, into that state. And it's way more complex than that. And I'm not going to go into all of the things that can trigger taxation or non-taxation, but the hyper simplified version is that if you're a company, maybe you're a manufacturer, you're selling something into a state, but you don't have people permanently employed there. You might have maybe a traveling salesman, no permanent employment there, no property there. You are not subject to that state's corporate income tax or other business taxes. And for a lot of smaller and mid-sized companies, this is the case. We think of the big companies that are present in every single state, and they're all captured by corporate taxes in these states in various ways. But a lot of companies, even if they have a broad sales network, they may not be the one delivering that property. They might be selling to a network, a distributor, a wholesaler, whatever. They might have sales everywhere when it's all dispersed, but they are only operating in a couple of states. And they can't be taxed there, even though corporate income taxes, when we think about how they're apportioned, they can be apportioned on some combination of where the sales are, where the payroll is or where the property is. And increasingly, the most common way to do this is just what's called single sales factor, to only care about sales. So you might have a company that has millions of dollars worth of sales in a state, but doesn't have any taxable nexus in that state. So none of their corporate income can be apportioned to that state for taxation right now. If, however, they have any payroll or property in the state, that defeats the protections of PL 86-272. And suddenly, all of the apportionable income, all that sales income, can be brought in and can be subject to taxation. And one way, of course, this can happen is an employee relocating there. And right now, that's happening all the time. Employees are showing up at places all across the country. I don't even think they're often talking to their tax or HR departments or even their boss before they pick up and move. It's not clear how many states are going to be able to track where this is, but if you have an aggressive enough tax department, I think you have a situation where a state can say, hey, we've always wanted to tax you as a company. We weren't able to, but you've got 3 people here now. And we are going to subject you to taxation. So Nikki, how much of a problem is that? And what sort of solutions can there be, especially if we want to have a more telework-friendly tax code? Because I think it's a concern if you have to put your foot down and say to an employee, sure, you're in our sales department, but we can't let you work in that state because you will create millions of dollars of liability for us.
I mean, this is a huge issue, and Public Law 86-272, while well-meaning and, kind of as good as we've had it for the last several years, is just significantly insufficient. And mostly because it only applies to the sales of tangible personal property. And so as our economy has shifted and there's so many more businesses operating in the service space or intangible space, we simply just, it just doesn't cover those employees. And so it has been insufficient for many years, and we need a broader fix. So what have we seen? What have we seen for fixes? Well, we had the MTC come out with their factor presence rules. And we've also seen the MTC try to completely eviscerate Public Law 86-272, so strip those protections from even the limited number of companies that still have it. Now, the MTC has said, well, hold on, no, that's not really what we're doing. But if that's been the result, if that's the result of how we're interpreting this Public Law 86-272, just look to our factor presence Nexus standards. Well, Jared, a $50,000 payroll standard, who does that protect? Any company that is paying their employees, especially in the tech space, we're seeing people flood away from San Francisco. Those folks are making significantly more than $50,000. So I have advocated to the MTC that they need to re-examine their thresholds. So maybe that's one place to start, is those Nexus thresholds and really getting the states to adhere to that. But I don't see the states going much above $250,000 or $500,000 of payroll in a state. And I don't know that offers significant protection to really help employers that are creating meaningful jobs. So I think this is going to have huge implications for businesses. I think in the startup tech space, where we see a lot of Silicon Valley employers saying, work from anywhere, we don't care anymore. I mean, I've already had folks from the Montana Department of Revenue calling me and saying, hey, are there a lot of your members that want to move to Montana because the housing market is going crazy, but these people are all like making a bunch of money from California, right? Like, I can tax them, right? And I try to just say, no, look over there. This is not what you think it is. But the states are, especially some of those more rural states, see a significant opportunity to not only pick up income tax, but also to pick up corporate income tax or, business entity taxes. And I think we may see, if we can't get a uniform congressional solution that provides some relief, I think we're going to start seeing states divide into states that are willing to maybe forego the corporate income tax to pick up that additional personal income tax. And so they will be more favorable on these issues. And those states that I will describe as the better off dead, I want my $2, and will be very hardcore and go after everything they can, they will take it to the full, they'll go after every dollar under, their constitutional abilities. So.
Yeah. That tax competition element is really interesting because some of these turn traditional tax competition on their head. We talk about people and businesses being more mobile these days than they used to be. We talk about the ability to make locational decisions. And I think very legitimately, most people think that you're making some sort of implicit trade-off. Some people want to live in a state that has more services, and there may be higher taxes that pay for that. Some people want the opposite trade. And part of the beauty of our 50-state system is you have the ability to make some of those decisions for yourself. But when states can tax activity that is outside of their borders, then suddenly a lot of those choices are stripped away. Yeah. You're taxing people who have no ability to vote on these, who are not necessarily present in your state, who are not part of that decision-making process. It really changes what it means to have tax competition and can seriously limit it. But there are places for competition even within this framework. And I think you hit on one of them that's really important, because even if there's a threshold, even if it's $250,000 or whatever it may be, which would be a lot higher than what we have right now, that doesn't really make you a friendly state for telework. If a company wants to say, hey, go work anywhere, they have to actually say, well, either we're willing to pay taxes everywhere, or we're going to say, sorry, you have to check with us first because we can't let you be the employee who pushes us over and we're paying more in taxes than we're paying you in salary or getting from you in benefit. That's just not going to work for us. Some companies are going to say, you know what, we're big enough, we're going to be everywhere, this is fine. But a lot of companies, that's going to be a problem. And you can imagine states positioning themselves as telework-friendly locations and saying, listen, you simply locating here as a remote employee is not going to trigger business liability, and we're going to be equitable with you in lots of other ways. So your company can say, feel free to go to X state. This is wide open to you. Here's the list. Now, obviously, if the company has an office there, has property there, there's other things that would clearly give them presence in the state. But simply having a fully remote employee, maybe some states say no. In the same way, I think the convenience rule can have a competitive element. In the short term, not really. In the short term, it's this revenue grab for some states in New York or other states, Massachusetts doing this. They want to basically hold revenue constant. Massachusetts has been collecting income taxes on New Hampshire residents who are driving into Boston and working there, and that's fair. They were working in Boston. If they're no longer working in Boston, they're not using the state's resources. And I understand from Massachusetts' perspective, they counted on this revenue and the pandemic took it away, and that's scary and that's tough. But they're not doing anything in Massachusetts that would subject them to taxes. And in the longer term, you have people who never did so and will never do so, who can be subject to another state's taxes, and in some cases double taxed. In New Hampshire, it's a tax when you wouldn't pay one since they don't have an individual income tax in New Hampshire, but many places it would be two different sets of taxes. And in the short term, that can capture additional revenue because people have very few choices. They just end up paying double taxes very unfairly. But in this mid to longer term, companies are going to think very seriously about where they're located, or where they have certain offices that they can attach people to, if that makes it easier or harder for them to enable telework. Some companies don't care. Some companies only can have physical work, or vast majority will be physically present, and maybe these rules don't apply to them. But I really do think that remote work flexibility is the wave of the future. Doesn't mean we're all working remotely, but a lot more flexibility is clearly coming. And states that stand in the way of that in a longer time horizon are probably going to lose out on the businesses and the individuals who want to take advantage of those opportunities. It's a short-term versus long-term calculation. And we're going to see a lot more of that in, I think, the coming years.
So Jared, just to kind of bring it all home, and I agree with everything you're saying, do you think that makes it more or less likely that we could get a congressional answer that creates uniformity? Because I think the states, as we've seen them on many issues, will, the states do not want to give up their rights here. And there is, the flip side of it is there is this opportunity for for there to be competitively, competitive states that are favorable to taxpayers. So how does that play into our hope of a uniform congressional standard?
Yeah, so if the competition works, if states by foregoing this are attracting a lot of business and activity, you could see other states revisit it, but I don't think you'll get everyone there. The only way that happens is probably with some sort of federal response, or in some case, maybe a court response, but something exogenous to the state policy making. The way I've seen a lot of these issues is that they're not really partisan issues. They're not right and left so much as the states that have been the net beneficiaries against the states that are the net losers or have their residents be the net losers. And for better or worse, some of the states that have benefited the most, especially New York, have legislators who are in very powerful positions in leadership in both chambers, and they've been very successful in blocking this. And that's been a bipartisan thing. Republican and Democratic members from New York, whichever party's in power, they have not wanted to see this go through. And there's probably some other states like that as well. They won't necessarily always be in leadership, and there may also be more of a groundswell. I think that if people from a bunch of states go to their tax preparers next year in March and April and find out that they owe 2 sets of income taxes and they owe thousands of dollars that they didn't think they owed, that could make a lot of other members of Congress who represent those constituents very unhappy in a way that they really haven't had that salience on the issue previously. And obviously leadership is powerful, but leadership isn't all powerful. If that groundswell exists, it makes this more possible. Am I predicting that we solve all these problems soon? No, absolutely not. Do I think that as we become more telework friendly, that we might start to see progress and building up a coalition on this? I think so. I think these things are in play. And I know that Cost has been doing a lot on that, will continue to. And I also know, spoiler, I guess, for people who aren't aware, that you are moving on. And I wanted to give you an opportunity to tell us about that and introduce a colleague of yours who's going to be covering some of these issues so that people who want to talk to you as well as us know who's working on these things.
Thanks, Jared. Yeah, and I just on the point of we'll know more come next April when people are actually filing their returns, I think is a great point. I think the rubber will maybe meet the road there. So yes, Cost has been working on the mobile workforce efforts for many years. So joining us for the Q&A session is Aziza Faruqi, who has been kind of spearheading this issue at Cost for many years, and she can speak to a little bit more of the specifics of the coalition. At my time at Cost, I've been with Cost for 5 years now. I've seen the membership, struggle with this issue, be frustrated over this issue, but I know that I'm leaving it in very capable hands with Aziza and the rest of the staff. And I am moving on to Evershed Sutherland next month, and obviously hope to continue to join Tax Foundation from time to time to talk about these very important issues. But thank you for joining us, Aziza, and we'll see if Scott has questions, or Jared, if you're going to be doing a little of the Q&A here.
Yeah, I think that we've been sort of working our way through some of them as we've had this conversation. One question we just got is whether a company can require employees to only work remotely from a certain state, maybe the employer's home state, or maybe to expand the question, a list of states. Aziza, do you want to talk about what employers' rights are versus employees' rights in this situation?
Jared, thank you so much for having me. And Nikki, you have had a tremendous conversation on this issue. I think especially in this day and age, talking about, when we're living in the age of COVID-19 pandemic, I think most of the employers right now are very protective of their workforce and are not really forcing, their employees to work from, coming into the office or anything like that. They are protective of the workforce. This is something that employers take very seriously. So employees, basically, depending on, what their situation is, are, just as you said, are either working from their home states or working from other states. I am not exactly sure of employer rights in this instance, whether they can force employees to, work from a particular place or not, but definitely employers are following the lockdown orders in this day and age. They have to abide by that. Nikki, do you have any additional information you would like to put here?
Yeah, I mean, I guess I would just say as a legal matter, if I were an employer, I would be very cautious about, especially in the time of COVID, mandating that an employee have to be in a certain place. I think, not to go a very different direction, but there are certain constitutional rights that all individuals have, one of which is that they can't be subject to involuntary servitude. So I don't think anybody would want to tread on that sort of issue. So I would caution folks to be very careful there. That said, again, these are super complicated issues as an employer. So I think having first that broader conversation with your own counsel, understanding the tax implications, and then putting together a plan for the company is one thing. Now, whether or not you can restrict employers through, how they're paid or things of that nature, I would call those incentives, so carrots rather than sticks, I think are probably options that can be explored. But I think this is one where employers have a responsibility to think about these issues, but also they have to be mindful of the safety of their workers, as Aziza said.
Yeah, and I think that's a huge distinction between the now and the later, that during a pandemic, almost every employer has set aside these tax implications for now. They're probably hoping for relief. Some states are offering that relief on a temporary basis, but they are not requiring people to stay somewhere that could be unsafe or that's not available to them. But broader telework policies that outlast the pandemic are optional policies. No company has to allow people to telework, and whether those arrangements are allowed can very much depend on what the tax environment looks like. So state competitiveness on this can matter a lot. There are also, as we really try to wrap this up, there's some questions about the short-term options and solutions. And there was a reference on, in Congressman Pappas's remarks to something that was in the Republican relief bill that could also show up in a Democratic relief bill, wasn't in the previous one, but you could imagine both sides thinking about this, which is something closer to the mobile workforce style provision, but on a temporary basis. So the idea was that it sets a 30-day threshold. You need to be in a state for 30 days before you're subject to its taxes. But for 2020, this year, it's 90 days. And the idea there is that if you went remote, in March, in April, you had nowhere near 90 days in the office. Basically, as long as you are remote from like sometime in March through sometime in October, you wouldn't reach that threshold. And therefore, even if you had a convenience rule in your state or moved around a bit, you'd be protected. It's not a direct response to the convenience rule issue, but it's a high enough one-year threshold that it basically accomplishes that for a lot of people. That particular approach, it was Senator Thune's bill and got rolled into the HEALS Act, which obviously was the Republican bill, did not go anywhere on the House side. That also had a 30-day rule that extended through 2024 before expiring. That part would probably be significantly more controversial because it does get into this broader mobile workforce issue, but it's not utterly implausible that we could see additional relief at the federal level, maybe a bit retroactively, but for 2020. We're also seeing states taking the high ground on this. I mentioned New Jersey, but there's other states that have created voluntary rules where an individual or a business can elect to be treated as if nothing changed. If it's in their best interest to continue to be taxed as if they were working in the state they were previously working in, they can choose to do that for 2020. States are not obligated to do this. And in fact, this is states voluntarily waiving taxes that are more legitimately owed to them than to the state that will ultimately be claiming some of those taxes. But it's a very taxpayer-friendly move trying to avoid a legitimate, significant unfairness falling on taxpayers. What's interesting, the first two states to offer this, kind of polar opposites, were New Jersey and Mississippi. But a lot of states did follow up on that. And I think that can be a very valuable thing that states are going to continue to consider, and at least putting thresholds in, because as we've all talked about, most states are not going to have the capacity or the desire to go after sort of the everyday employee. Taking that legal obligation off that individual could make a lot of sense. Again, not for the 6 months located elsewhere, but trying to create some simplicity for people who might have bounced around briefly during a pandemic. And it's certainly addressing the convenience rule issue. I think a lot of things that we need to be focused on in the coming years. Someone had asked about constitutional issues if federal government steps in and tells states what to do on their own taxes. And I think to that, I would just say really quickly, Congress has very, very limited authority to tell a state how to tax its residents or to tax activity that takes place in the states. Congress does have an inherent authority to deal with interstate tax issues. So when a state is taxing activity that took place outside of a state, when there's a question of how those things are defined, obviously the courts can adjudicate where those lines are, but Congress does have that authority. That is the reason why we've seen what legislation we do have on these issues. It's the reason why we can talk about things like a mobile workforce bill or a multi-state telework type bill or other approaches. The Business Activity Tax Simplification Act is the other big piece of legislation that would be sort of a modernization of that Public Law 86272 on the services side, but still doesn't address the issue that Nikki and I were talking about where there's the thresholds question. So there's probably a lot for Congress to think about, for states to think about for fairness sake, and for long-term competitive advantage. These issues are not going to be resolved overnight, but they become way, way more important because of a pandemic and because of the way that we see the economy going. We were already shifting towards a more remote work-friendly environment, a more telework-oriented business system. We have, for years, decades, been seeing more mobility by individuals and by businesses. Capital and labor have become more mobile, but this is an extraordinary acceleration. And while obviously a lot of us are going back to the office, hopefully sometime soon, it's going to look really different. The degree to which people were working remotely a couple of years from now is going to look vastly different than what it looked like 2 years ago. States need to start addressing these questions. I think this is a conversation that needs to continue. So I'm really grateful for everyone who joined this call today, this webinar. We answered some of the questions. I know we didn't answer all of them. Reach out to me, reach out to others. We'd be happy to try to follow up with you if we didn't get to your question. And we'll be continuing to engage on this. I do have a paper on the convenience rules published a couple of weeks ago, and we'll be writing and researching on all of this. And I know that COST has a lot of great resources on this as well and is engaging in this. So thank you, Nikki. Thank you, Aziza. And while he had to leave because the suspension calendar got pulled, thank you certainly, Congressman Pappas, for joining our webinar today. And thanks for every one of you who participated.